Chapter 2 is our first real introduction into debits and credits and actual journal entries. Chapter 2 focuses on the accounting cycle during the period rather than the end of the period. And as such, the main focus is on external transactions. So when the company has an exchange with an external party, whether it's an owner, a creditor, a supplier, or a customer, they're going to record this transaction with a journal entry so it hits the trial balance and eventually the balance sheet, income statement, and all that good stuff. I've already talked about double entry bookkeeping, but if you'll recall, in an exchange, we give something up to get something. Right? So we have to record what's going out and what's coming in. In accounting, we have basically, at a minimum, we have two lines, a debit and a credit. In accounting, debit just refers to left and credit just refers to right. And if we think about that basic accounting equation, assets equals liabilities plus stockholders' equity, it is set up. Assets are on the left, liabilities and equity are on the right. And as such, assets normally have a debit balance, while liabilities and equity normally have a credit balance. So anytime in a journal entry, when we debit an asset, we're going to be increasing the asset. Anytime we credit an asset, we will be decreasing that asset, reducing the value in the account. Similarly for liabilities, anytime we credit a liability or equity, we are increasing the amounts in those accounts. Anytime we debit liabilities or stockholders' equity, we are decreasing what's in those accounts. And if we're going to talk about journal entries, there's a minimum of 4 parts. We'll have the 2 accounts that are affected. Remember, there's got to be at least 2. We're giving something up and we're getting something. And then the amounts. So if we think about raising funds, we have cash and maybe we have notes payable. Right? There's my 2 lines. I debited cash, I credited notes payable. So I increased an asset and I decreased a liability. And now all that's left is how much did we raise? Or how much did we borrow? $15,000. Right? So we're set up. There's the 4 parts to the journal entry, the 2 accounts and the amounts that are affected. Now keep in mind as we go throughout the day, debits increase assets, decrease liabilities, and stockholders' equity. Right? They also increase expenses and decrease revenue. So anytime on the debit part of the journal entry there's an asset, that asset's going up. If there's a liability, that liability's going down. If there's an equity account, equity's going down. If it's an expense, expenses are increasing. If it's a revenue, revenues are decreasing. And if you recall, these guys get rolled into stockholders' equity, so it makes sense. If we're decreasing revenue, we're decreasing stockholders' equity. If we're increasing expenses, we're decreasing stockholders' revenue. Now, credits. Credits are the opposite. They decrease assets, so if in your journal entry you're crediting an asset, assets are going down. They increase liabilities. They increase stockholders' equity. They increase revenue and decrease expenses. these guys get put in stockholders' equity. So now we'll go on and we're going to walk through very slowly the transactions that are listed in your book. Transaction 1. Eagle issues stock for cash at $25,000. Okay, so as we talked about in class on Tuesday, you have to get money from somewhere. And to start your business, you're going to get there by issuing ownership, equity, and issuing debt. Okay? In this case, we're issuing equity, common stock. So as we're looking at it, think about what we gave and what we gave up. We got cash of $25,000. Cash is an asset. We want to increase cash, so we're going to debit that. Put it on the left side, $25,000. Right? We want to increase equity, so that's going on the right side. As you can see, I have a 1 beside it. That tells me these two are linked. Now if we do so this is a T account. A T account is just a visual representation of our transactions throughout the period. So there's no transactions in there before, so we're working with this. And if we create our journal entry, we debit cash and we credit common stock of $25,000. So the T accounts and the journal entries line up exactly. We received cash of $25,000. Cash is an asset. It increased, so we should debit it, put it on the left side. We issued common stock. That's what we gave up. So we should credit it and put it on the right side. Now, Transaction 2. Transaction 2, Eagle borrows $10,000 from the bank. So now we're raising money on the debt side. We are issuing debt. We're promising to pay the bank $10,000 at some point in the future. That's specified in the contract. And we'll have interest expense that we're going to incur as we go along because they loaned us money. And they're not going to loan us money for free. So again, cash, which is our asset, is going up. And notes payable, our liability, is going up as well. And as you can see, we already have in our T account what happened from the previous one in cash. We didn't have any transactions already in notes payable, so it's blank. So we'll enter our second transaction, $10,000 cash coming in. We'll recognize that $10,000 notes payable as well. Now we create our journal entry. It's going to match up, remember. We're going to have cash of $10,000 and a note payable of $10,000. Again, we're increasing assets, we're increasing liabilities, so our accounting equation is going to stay in balance. Transaction number 3. Eagle's buying equipment worth $24,000 using cash. So in this case, we're essentially trading one asset for another. From an accounting perspective, we're just taking out of one pocket and putting in another. We're staying on the asset side of the balance sheet. We're just transferring values. We no longer have that $24,000 in cash. Where did it go? We used it to purchase equipment, so we're going to put it in equipment. So we will reduce cash by $24,000, and we will increase our equipment account by $24,000. And we're going to do our journal entry, and it's going to match up. So journal entry 3, we're going to have equipment 24 and cash at 24. Right? So nothing happened on the liability side, nothing happened on the equity side. It's all on the asset side. So the fundamental equation didn't change. We just shifted within asset classes. We took money out of cash and we put it in equipment. Transaction 4. Eagle pays 1 year of rent in advance, cost of $6,000. Now, this is a preference question, essentially, or a preference entry. We haven't used the rent yet, so it's not exactly accurate to put it in rent expense, although some companies may do it. And all that's going to change is your entry in Chapter 3. What is your adjusting entry? But right now, we're just going to say we haven't used it. So we're going to create an asset called prepaid rent, because we have the right to use this for a full year. We've already paid for it. We have the right to use it for a full year. So we're going to take $6,000 out of cash and put it in prepaid rent. And then you'll find in Chapter 3, as time passes, as we use the rent, we'll recognize rent expense, but we'll wait for that there. So let's do our journal entry. We're going to have prepaid rent, $6,000, and we're going to have cash of $6,000. Again, from an accounting perspective, we didn't change anything but assets. We just transferred stuff within asset classes. Alright, the last transaction for this video tutorial is Transaction 5. And Eagle is going to buy supplies from a supplier, but not yet pay for them. They're going to issue a promise to pay. And we're going to call that promise to pay our suppliers accounts payable. Alright, so we're going to create this liability. Right? As you can see in our T accounts, we don't have any beginning balance or prior entry affecting supplies and accounts payable. So in this case, we're increasing assets, supplies. We're also going to increase accounts payable, right, our liabilities. So we'll go Transaction 5, 2,300, and then on the liability side, right, 2,300 for Transaction 5. So in this case, our assets, liabilities, and equity stay in balance. We increase assets by 23 and increase accounts payable by 23. Let's do our journal entry. Supplies. And accounts payable. Okay, so debiting an asset, remember, increases that asset. Crediting a liability increases the liability.